Investor interest in cheap stocks, particularly those priced under $10, is surging, and it's a trend worth exploring. There's a certain allure to these low-priced stocks. They seem like a bargain, a chance to get in on the ground floor of a potential success story. But before diving in, it's crucial to understand what's driving this interest and what pitfalls to avoid. First, let's talk about the market conditions. With inflation concerns and economic uncertainty, many investors are looking for value. Cheap stocks can appear to be a safe haven, especially when larger, more established companies are facing volatility. The idea is simple: buy low and sell high. But remember, just because a stock is cheap doesn't mean it's a good investment. One key factor fueling this surge is the rise of retail investors. Platforms like Robinhood and others have made trading accessible to everyone. This democratization of investing has led to a frenzy around stocks that were previously overlooked. Retail investors often flock to these low-priced stocks, hoping to replicate the success stories of companies like GameStop or AMC. But this can create a bubble where prices are driven up by hype rather than fundamentals. It's essential to do your homework. Look for companies with solid fundamentals, even if their stock price is low. Analyze their financial health, growth potential, and market position. A low price can sometimes reflect underlying issues, such as poor management or declining sales. Don't get caught up in the excitement without understanding what you're investing in. Another aspect to consider is volatility. Cheap stocks can be incredibly volatile, swinging wildly in price based on market sentiment. This can lead to significant gains, but also steep losses. If you're not prepared for that roller coaster ride, it can be a nerve-wracking experience. Set clear investment goals and be ready to stick to your strategy, even when emotions run high. Additionally, watch out for the influence of social media and online forums. While these platforms can provide valuable insights, they can also spread misinformation. A stock can be hyped up overnight, leading to a surge in price that may not be sustainable. Always cross-reference information and rely on reputable sources before making decisions. Lastly, consider your risk tolerance. Investing in cheap stocks can be part of a diversified portfolio, but it's essential to balance it with more stable investments. Don't put all your eggs in one basket. A well-rounded approach can help mitigate risks while still allowing you to take advantage of the potential upside in these lower-priced stocks. In summary, the surge in interest for cheap stocks under $10 is a fascinating trend driven by market conditions and the rise of retail investors. However, it's crucial to approach this space with caution. Do your research, understand the risks, and maintain a diversified portfolio. By doing so, you can navigate this exciting yet unpredictable landscape with confidence.